I think there's been a dual shock from both the tariffs announced by President Trump, as well as OPEC announcing that it was going to accelerate its production increases. And that has led to oil prices coming down quite significantly, closer towards $60 per barrel in the last week. So, of course, that is a much lower oil price than what we saw last year, which was around $80 per barrel. And it does have an impact on the fiscal deficits, particularly for Bahrain, for Saudi Arabia, and for Oman. So that is the main transmission channel for the GCC economies.
So what is the price level that we need to be looking at, and how exposed are the GCC sovereigns if we fail to see oil holding above $60 US, for example, where we're trading right now?
Sure. Yes. I mean, this is where we think back to 2015, right? And what happened then. I mean, so for much of the GCC, and that includes the likes of Abu Dhabi, Qatar, Kuwait, they have very large asset buffers in their sovereign wealth funds. So they are quite well cushioned against a sustained drop in oil prices. Now, the countries that we would be focusing on is more Bahrain, Oman, and Saudi Arabia, which have the most sensitivity towards oil prices. But at the same time, we did recently upgrade Saudi Arabia's rating to an A+. 6 months ago, we also upgraded Oman to a BBB+. So compared to the last decade, the policy mechanisms in the region are much stronger. There is a lot more policy flexibility, and we think that the governments would step in to adjust their spending, potentially raise some more non-oil revenue as well to manage the budget.
So let me test you on this then, because as you say, S&P has just recently upgraded Saudi Arabia. How confident are you in that current rating? Because Goldman Sachs also told us last week that $60 oil could double Saudi Arabia's budget deficit. Is Saudi Arabia, for example, at risk of ratings revision or a ratings change in the next couple of months as a result of what has just unfolded?
Yes, $60 per barrel is definitely quite far away from its fiscal break-even price, which is closer to $100 per barrel. But that said, the rating upgrade that we did recently was more based on structural improvements that we've seen in the institutional settings of the country, as well as the economy. We see continued economic diversification with Vision 2030, ongoing social liberalization, which means that the labor market reforms and job growth will be coming for the young population. And those are some key strengths that we think will provide the economy a little more resilience over the longer term. So, of course, in the near term, there are going to be these very large fiscal deficits that we're going to see. We're expecting it to be at about 4.6% of GDP deficit for this year, and over the next 3 years at about 4% of GDP. But, Saudi Arabia does have the fiscal space to manage these short-term fiscal deficits. The debt to GDP is only at about 30% of GDP right now. More importantly, on a net asset position, they're still in a very comfortable position at about 50% of GDP because they still have sufficient buffers in, again, the sovereign wealth fund.
But again, if oil prices fall further from here, it is realistic to expect that Saudi Arabia may not deserve that current rating.
Well, I mean, so we try to look through the cycle. So it depends on where oil prices land over the longer term. But more importantly, it will matter the government's policy response to the oil prices. So our assumption is that the government will scale back some projects. They will postpone some projects under Vision 2030 as well, because ultimately these deficits for them are a policy choice. And so we are expecting a bit more flexibility there, and we're not expecting the deficits to go beyond 5% of GDP.